Good afternoon, ladies and gentlemen, and welcome to the FILTA Group Holdings PLC full year results investor presentation. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated in the right-hand corner of your screen. Simply type in your question and press send. The company may not be in a position to answer every question received during the meeting itself. However, the company review all questions submitted today and publish responses where it's appropriate to do so. These will be available via your Investor Meet Company dashboard, and you'll be notified once they're ready for your review. We'd also like to remind you that this presentation is being recorded. Before we begin, we'd like to submit the following poll. I'd now like to hand you over to Jason Sayers, CEO, and Brian Hogan, CFO of FILTA Group Holdings PLC. Good afternoon.
Hi everybody, and thanks for having us. I just thought it'd be worth playing a quick video of an overview of our business. It's 4 minutes, and I think it would help give everyone some perspective on what we do. Paul, would you mind playing it up there for us?
At FILTA, we provide eco-friendly services to commercial kitchens in the UK, Europe and North America. We are a trusted operator working with global brands. Our client base includes restaurants, schools, stadiums, hospitals, universities, supermarkets, hotels, casinos and amusement parks. We are an approved services provider to the world's largest contract catering companies. In fact, anywhere food is prepared. Our strategy is to secure repeat revenues through both franchised and company-operated models. Over 20 years ago, the founders created the original service FiltaFry, the cooking oil filtration and fryer management service. This groundbreaking service is now provided to many thousands of commercial kitchens around the world. The best part, our service is scheduled once, twice or 3 times per week, creating extremely high repeat revenues and building excellent customer relationships. Our fryer management service is provided through our network of FiltaFry franchisees. We pride ourselves on the high level of support provided to our franchisees, with programs such as in-field and inside sales support, tech recruitment handling, and ongoing business coaching that help drive the franchisees' businesses forward. In 2002, the founders moved to the USA and have driven the growth of our fryer management business. Whilst franchise sales continue, the key driver for FILTA's growth is achieved by our existing franchises, expanding their customer base, creating additional royalties for FILTA. With franchise owners in the UK and the more recent expansion into Europe, including Germany, Austria and Spain, FILTA still has tremendous room for growth with its fryer management service. Whilst our origins were through the franchised model of the fryer management business, our business model is to generate repeat revenues from either franchised or company-operated businesses servicing commercial kitchens. In 2011, we started our first company-operated business in the UK, employing and managing technicians directly with the unique and patented FILTA Seal service. This service allows us to manufacture and replace fridge seals on site in one visit, saving customers money and time, providing repeat revenues to FILTA. In 2017, we expanded our company-operated business to help manage fats, oil and grease issues in kitchen drains. We fit equipment that removes oil from wastewater, preventing blockages and fatbergs forming downline, helping customers become compliant with water authorities, while saving clients time and money. We then service those units every month or quarter, providing FILTA with predictable repeat revenues. More recently, we expanded our company-operated business again by offering the automated vent cleaning system to our clients. Once we fit the system, our eco-friendly solution is sprayed daily into the vent, cleaning all grease, helping eliminate fire risk and keeping the customers compliant with the ever-increasing fire regulations. Once again, the regular servicing of the system provides FILTA with highly predictable repeat revenues. Our model is simple. Yes, we continue to sell new franchises, but that's just a starting block and a small piece of our business. Our repeat revenues from fryer management continue to grow. Our driving goal is to continue adding additional service vans via our existing franchise owners expanding or via new franchisees in available areas. Either way, FILTA generates additional guaranteed fixed revenues for every new unit put into operation. Restaurant brands, for example, are measured by opening new locations. Our network size is measured by the number of service vans we operate. Similarly, on the company-operated side in the UK, equipment sales continue, but the major goal is to constantly keep driving the repeat revenues and upselling additional services to our ever-growing customer base. We do all this whilst delivering products and services that help the environment, providing our customers with regular environmental impact reports and certificates, which help with their own internal compliance. By 2019, FILTA calculates that our services have helped reduce our customers' carbon footprint to the equivalent of planting 17 million trees. Thousands of customers around the world rely on and value FILTA's services, servicing commercial kitchens, ensuring compliance, driving repeat revenues. FILTA Environmental, an award-winning world leader.
Okay, thanks, Paul. So that gives you a bit of an overview of the business. And as you can see, we service commercial kitchens. And the best thing about our business, as you can see, we have regular repeat revenues from those customers. The downside, our industry was hit pretty hard by COVID. At its lowest point, our UK and German markets were closed, 90% reduction in revenue. What was in our control is how we reacted. So we were still profitable, £1 million at the EBITDA level, including 300 grand bad debt provision for COVID, and we were cash positive. So it shows a pretty robust model and team. Today you've got myself and Brian Hogan. I'm the CEO of the business, and Brian Hogan's our CFO. We're both based here in Florida, so we both operate out of here, and we run everything from here. I'm going to slip through to the next slide there. So a bit of an overview of the business. I started the business in the late 90s in the UK when I came up with the idea for Filter Fry, cooking oil filtration and fryer management service. We expanded this through franchising in the UK and through selling master licenses in other countries. But the obvious market for our service was the States. So in 2003, I came across to the US with my business partner to grow the business here. So we now operate in the UK, North America, and primarily Germany and Europe. We have two primary businesses now, Filter Fry and the cooking oil filtration and fryer management service, and a grease and drain management business in the UK. We service well over 7,000 commercial kitchens every week, and we deliver the fryer management service through a network of 191 franchise owners who pay us fixed royalties and fees. And we deliver the other kitchen services through 55 company-owned operations in the UK. Both provide us with pretty fixed repeat revenues for our business. The historical and future growth comes in somewhat from new franchise sales, but the most important thing is existing franchise owners expanding and our operational business expanding. So we're now well positioned to take advantage of the recovery we're seeing in our sector. You saw a little bit about this, but this is a graphic of a kitchen. So let me explain what we do. Everything we do is focused on high margin recurring revenue from that customer base. Filter Fry there, cooking oil filtration and fryer management service. So problems in kitchens include high oil use, poor quality food, hot oil accidents, slips, falls and burns, insurance claims. So we solve all those problems with a Filter Fry service. So our van turns up on site every week, once, twice, 3 times a week. We wheel a machine out the van next to the fryer, suck the oil out of the fryer, clean the fryers, pump the oil back in that's been filtered, they reuse the oil, and at some stage the oil comes to the end of its life, we sell it to make biodiesel. The cost is usually recouped by the customer's savings in oil and labour, and the competition primarily has been in-house employee doing it themselves. We have 468 trucks on the road performing this service, primarily in the US. So Filter Fog's our next service there. Washing up dishwashers and floor cleaning carries a lot of fats, oil and grease into the sewers. This leads to blocked drains for the kitchen and fatbergs for the main sewer system, blocking flow permanently. So we install grease recovery units, GRUs, under sinks that separate oil and water before it travels down the drains. We have the best performing equipment on the market. It separates better than anything else, and it has lower running costs than anything else on the market. We then sign contracts to clean and maintain these units monthly or quarterly, providing ongoing service revenue for Filter. Really, we're there to keep the customer compliant with the ever-increasing water authority enforcement. Filter Seal is our next service. So the same customer base have fridges. Those fridges have seals. Those seals need changing when they wear out every year or so. Typically, when a customer has to replace a seal, they call the refrigeration company. It comes out, looks at the seal, measures it, orders it, comes back, fits it another time. Time-consuming and expensive. In 2010, we bought the patent to some equipment that allows us to turn up on site, measure the seal, manufacture it in the van, and fit it all in one visit, providing great service and saving customers time and money. Again, we keep the customer compliant with health and safety regulations. Filter Pump, the same customer base, has pump stations for pumping waste off-site. We install and service these, keeping customers compliant. And Filter Vents, you saw in the video there, we introduced an automated vent cleaning system last year. Very early days for this product, but we hope to roll it out in the coming years through our existing customer base, once again, keeping them compliant with fire regulations. I'm just going to whiz ahead to see how that fits into the model. So on here, you see, so how does this fit into our business model? We have 4 segments of revenue, as you saw in the video: franchise development, fryer management, equipment sales, and site service. Franchise development, one-off fees we get from selling a franchise. Then we have fryer management. This is the repeat revenues we get from our franchisees who perform fryer management service. We provide a lot of support for our franchisees: sales, tech recruitment, accounting, marketing, technology. So we generate fees in several ways: a fixed royalty per machine, per MFU that the franchisees have. They pay us $750 a month. We collect it by direct debit every month. They have 2 machines. We collect $1,500 every month by direct debit. So it's a nice system we have. We then make margin on parts and supplies, waste oil collections, and sales. So the blue part there on the left is from franchisees, primarily in the US. The green part on the right there is from the UK, is the company-owned operations. One-off fees from selling GRUs, vent, pump stations, and then we get the recurring revenue from servicing GRUs, seal replacement, vent servicing, pumps servicing, and the Filter Shield COVID service we introduced last year. The recurring part of our revenue are fryer management and site services, and that's what we look to build on every single year. Overview by market. So right now, this is getting into what's happened in the last year. So we're based in Orlando, Florida, here in the US. We only have 14 staff members in the US, supporting 146 franchise owners who have 422 machines. Network revenue in 2019, that's our franchisees' revenue, was $52 million. In Q1 last year, that had grown 20% year on year. So the run rate was over $60 million. We look at 20% growth every year in that market. Then COVID hit. Q2 was fairly strong, lockdowns in the US before it opened up in Q3 and Q4, to a point where we were back to almost 70% of prior revenue. We supported our franchisees last year by lowering their fees based on their revenue. So that fixed fee we've spoken about per machine, that got lowered based upon if they were at 50% revenue, 20% revenue, we lowered those fees accordingly to help the franchisees out. Those are back now. You know, we're only discounting about 10% across the board, and the market's come back significantly here. We also invested heavily in our sales team in the US, which resulted in picking up a lot of customers during COVID, a lot of local sites we picked up, and we're tackling the national accounts too. So that's the States now. The UK, we're based in Rugby in the centre of England. We have 36 franchise vans and 55 company-owned ones. In Q1 last year, we had improved the margins following the acquisition of Watt Bio the previous year. We were feeling pretty pleased with ourselves. Then COVID hit. Strong lockdowns in Q2, on and off ever since. More open in Q3 in the UK, then we're in the lockdown we're in now. We invested in the sales team. So at the beginning of lockdown, we made a couple of decisions. Let's focus on cash. No one knew how long this was going to last. So we focused on cash, and we also decided to focus our sales team on, 1, helping our existing customers, 2, going after a customer base we thought would survive during COVID. So we went after fast food, we went after supermarkets as well. So those have paid dividends for us, but we put a lot of effort into the sales team. In September last year, we introduced a new grease recovery unit, the Cyclone GRU, which has actually been better accepted than we even thought. It's now specified by many of the chains in the UK, specifying that as their only unit. As I say, it separates better than any other product on the market, and it has lower running costs than anything else on the market. More recently, we've changed the model slightly in the UK to a more capital light model. So on the FOG servicing side, we reduced the number of technicians we have from 23 down to 10. And we now have franchisees performing work on a pay-per-job basis in the UK. So we're really geared up for expansion now through giving more work to franchisees. In mainland Europe, we're focused in Germany there. It has a lot of potential for us in Europe. but they've been hit hard by COVID. Significant potential, but severe lockdowns in 2020, which continue far into 2021. We only have 3 staff members in Europe, so we've reduced the overhead until the macro picture improves there. One thing I would say, we've made a decision to take the GRUs into Europe during lockdown. Last week, we installed our first of the cyclone units in Germany. So we are looking to do that in Germany, and it's all going to be serviced through our franchisees there. But really, we're focusing all our efforts on the real growth now in the US and the UK. Let's look at North America. So many of you are probably less familiar with what's happening over here. The economy only shrunk around 3.5% last year in the States. The US government is injecting over $4 trillion into this economy, and you can feel it. Whether you agree with it or not, it's happening, and you can see it have an effect over here. Vaccine program is a success. I've been double vaccinated. Brian has. Everybody I know here has had double vaccinations. Here it's 3 weeks apart, not 3 months. So the economy really is opening up. As I say, here in Florida, in September last year, they opened everything up fully. There's no restrictions. So ever since then, we've been eating out, and life is fairly normal. There's been a lot of cases of COVID, but hospitalizations haven't been that high, and everything's been open here. Different parts of the States, like California, had severe lockdowns. New York, they've now reopened too. So everywhere has reopened in the States. We're seeing some of the business stadiums come back in. The OECD predicts US growth rate of 6.5% this year. That has already been increased since we wrote this, 4% for next year. You can see here on the right there's a chart. Pre-COVID in the States in January last year, we serviced around 6,000 sites. This January, we serviced around 4,500 of those sites. We have added during lockdown 935 sites. So that's been a bonus. And then we still got 1,500 sites to open. Those are our biggest facilities. So that's all the stadiums we do. We do universities over here, business dining. A lot of the contract catering is still to come back. To give you an idea, the universities have said most of them are now opening in the fall and the autumn term out over here. Stadiums are starting to come back. We're opening the stadiums up, and they are doing catering. So that's coming back too. We expect franchise sales to accelerate. They've been slow, but franchise sales normally do well when there is higher unemployment and access to credit. Once our sector fully recovers, we expect that to recover for our second half of the year, and we can sell more territories. And look, we're really looking to take advantage of focusing all our efforts on accelerating sales in the US. Looking at the UK, everyone's more familiar with that. The economy shrunk around 10% last year. The government's been a great help, been exceptional over in the UK, and there's a lot of pent-up demand. Vaccine program has been a success. The opening up of the leisure sector is scheduled for Q2. With our biggest customer, Mitchell & Butlers, we've got Green King, we have they call Pizza Express, others haven't opened yet. They're in the process of opening right now. So again, on the right there, you see in Jan-Feb last year, we serviced 4,400 sites in the UK. Of those sites, this Jan-Feb, we serviced 2,000. We added 750 sites during COVID, and we still have 2,400 to come back. Those are the pub chains we do, the restaurants we spoke about, all of those are now coming back. So we've got the schedule of openings for those. Would expect some of that not to reopen. So some of the pubs that probably won't open some of their estates that were underperforming before COVID. But really, we service the higher volume sites anyway. So we do expect most of the majority of that to come back. We expect to be back full servicing run rates by the end of Q3 this year. Just looking at our markets, currently we service around 10,000 restaurants, 2,000 supermarkets, 1,000 hospitals. We service over 700 sports stadiums and universities. Some of those have over 200 fryers in a stadium. So that's our market over here. In the US, we have heavy contracts with Compass, Sodexo, Aramark, Delaware North, all the contract caterers we have exclusive contracts with. A lot of that business is still to come back. In the UK, we service major chains, McDonald's, Costa, KFC, Tesco's, Asda, Green King, M&B. So we have a great customer base there. During COVID, we've got very close with our customers. we're cross-selling more into them and getting close with them. So the growth strategy is to maximize existing customer relationships by upselling products and services, add complementary products or services, and then gain new customers, customer chains. Currently, we have less than 2% of the market, so we really are aggressively looking to expand in all of our markets there. I'm going to give you a quick look at this chart here. So this shows the slides over the years of our revenue and gross profit. So you can see 2017, 2018, we grew and our margins were just under 50%. We then bought WattBio in 2019, right at the end of 2018. Our revenues increased, but our margins decreased. It took us a long time, a year, to sort that out. You can see in 2020, our revenues decreased due to COVID, but our margins improved. This year, we're seeing higher revenues and we're keeping the margin. So we expect revenues to increase this year, and again, obviously next year back into full swing, but the margins to stay higher than they were in 2019. What I'll do now, I'll just hand back over to Brian, who's our CFO, to talk through some of the numbers, and I'll find your slide for you, Brian.
Yeah, take me back to 5 if you would, Jason. Thank you. I think it's pretty evident. I think if you were familiar with us before today or not, as Jason's mentioned throughout, the end market for our customers was arguably hit as hard as any other industry out there over the course of 2020. So not surprising, we saw a drop in most of our key metrics. But I think, if you were to ask the management team and the board today, looking back 12 months when we didn't know if this was a 1 week, 1 month, or 1 year event, that we would turn in 16.5 million roughly of revenue, still be profitable every month but one in the year, overall at 1.1 million of adjusted EBITDA, positive basic EPS, grow our cash balance, take our net debt down, we would have all signed up for that, I think, without question. Our focus back in March of 20 was cash preservation, first and foremost. And there were a couple other items that I'll speak to right after that. But it really was about working capital management, ensuring we were in a position to weather whatever the storm brought us. And I think we've come out of that in actually quite stronger position than we went into that, if that's actually possible to believe. And I'll expand on that just a bit. The other two things that we did is we really took an internal look at our business, and Jason alluded to this, and it was about how do we go to market, how do we operate, how can we be more efficient, and we spent what free time we had during the year focusing on that, and I think that is really a testament to the increase in margin that you're seeing, albeit it's a couple points. We do think there's considerable room for more movement on that. But we put in place some efficiencies that we think will hold as well as we move forward and grow the revenue. And the other thing, as Jason talked about, was getting closer to the customer. And I think, when you look at the roster of customers that we have, Tesco's, McDonald's, Costa, M&B, very heavily weighted to really brand names. And that, I think, is reflected in our performance and our opportunities as we move forward. The next slide, which is just a revenue and cash breakdown, it's just 4 very simple charts just to give you some perspective. I'll start at the top left. Really, our cash position today is roughly the same as it was at December 31st. So we've got in excess of 4 million of cash on the balance sheet. We've got availability of another 400,000 of an unutilized overdraft. We didn't need that at all during 2020, so it's currently unused, but it's available to us. So total available cash of 4.6 million pounds. And as you can see from the point we floated back in 16, apart from just a timing blip related to the acquisition of WattBio, back in 18, we're in as good a cash position as we've ever been. Our net debt is down to 0.5. That's ex of lease liabilities, and we're projecting that we'll be net cash positive by Q3 of this year. The product and service revenue analysis is, again, just a reflection on what happened to each of these revenue segments during the year. And I think the simple takeaway here is it was broadly based. It was COVID, it was broadly based. It wasn't specific to any individual segment that we operate under. So we were down about 1/3 in revenue year on year, and you can see that each one of those categories is roughly down about that level. The last chart, and something that I like to remind people who are not that familiar with the business, is we have nearly £3 million of deferred revenue sitting on our balance sheet. That comes in the form of territory fees that are related to the sale of franchises. So when we sell a franchise, there are two main components of that. There is the opening package, which you can think of as the tangible, and then there is the territory fee, which is the exclusive right to operate in the particular territory that they're purchasing. So we will recognize the tangible, which is the MFU machine, training, marketing materials. We'll recognize those revenues immediately. The territory fee gets put on the balance sheet and deferred over the life of the agreement. So just to give you some perspective, we're taking £50,000 a month off of the balance sheet directly to the P&L each and every month. And that's it's again just a benefit to the business, and it's a testament to the model that we operate under. The revenue analysis by region. Again, if you're not familiar with us, going back pre-Watt Bio acquisition, that was heavily weighted to North America, probably 70-30 at that time. So apart from all of the benefits that we saw with the acquisition of Watt Bio in the markets and customers it gave us access to, it really balanced the geographic dispersion of our business. And you can see just below that is the services that each of those offer. So again, as Jason mentioned, and as the video mentioned, North America is going to be principally your franchise model, and you can see that that's the sale of franchises and then the recurring revenue stream that comes from that. And that's similar to Europe on your far right. That Europe model is the US model that we're applying in Germany and Greater Europe. And then in the middle, the United Kingdom has prior management, because there are 30 or so franchisees that still operate in the UK, but again, primarily it's the equipment sales and installation and site income. And I think it's important to know, we say that we are a recurring revenue business, and we in fact are. So that prior management business is really on the back of the sale of franchises and growing franchisees that exist in the market currently. 85+% of that revenue is recurring. Overall in the business, 70% of our revenue is recurring. And site service serves the same purpose, kind of on the back of equipment sales and installation, where we provide the ongoing services to support the equipment. The next three slides are purely the financial statements, just a cutout of the financial statements. I'm not going to go line by line. I think it's, there's a couple points that I'd like to call out in here just to bring to your attention. Jason spoke to the 300,000 or so COVID debtor provision that we booked. Importantly, given, again, referring back to the customer base that we have, only about 65,000 of that is direct write-offs related to administration for some smaller customers in the UK. The balance of that is just prudent management around the debtor balances that did get extended during COVID, not surprisingly. The other thing that you don't see explicitly here is that we've offered, and Jason alluded to it as well, we offered about £800,000 of royalty relief to the franchise network. The result of that is just a direct reduction in revenue. It's not that we deferred that. It's not that we're going to collect on that. That was direct royalty relief that just reduced our revenues in the period. And just to provide some perspective, that was 50+% at the height of COVID last year, that we were reducing our royalties, and that's below 10% and dropping now. So I think, if you think about the US and where that model operates, principally for us, that's a strong sign that our franchises are seeing that their markets are improving as well. We've also seen improvements in equipment sales, parts and supplies. So all of that just points to some of the data that Jason presented and shows that our franchises are seeing improvements in their markets, and they're starting to reinvest back in their own businesses. We don't, as I mentioned on the recurring revenue, I did just want to highlight again that the third focus, as I mentioned, was the new customers, and you can see that we added a significant amount of new customers that we think we can retain as we move forward, and then on top of that, bring back those customers that were the hardest hit, the universities, the stadiums, which we should envision coming back in Q3. The balance sheet, again, I think it's served us well. We came into COVID with a strong net asset position and a fairly strong balance sheet. We've come out of it equally as strong. We've reduced the net debt position. Just a couple things to point out. We took, like a lot of companies, we took advantage of every program that was out there for us to take advantage of. That included the UK furlough program. That included a somewhat similar program in the US that was called the Payroll Protection Program. Both of those are grant-based, so there aren't obligations on the balance sheet related to those. There is, however, we took a C-bills loan early in COVID for $1.2 million. That is reflected on the balance sheet and is reflected in the net debt reduction. And those payments will begin in June of this year. I think the other thing to just call to your attention is that we have historically been a dividend payer. We paid or do pay about a third of our earnings, net earnings, out in dividends annually. That stopped during COVID, not surprisingly. The board recently decided not to pay a final dividend for 20 to be prudent. But I think what we've all agreed to as a management team and a board is we want to return to that, and we envision, given the way we're looking at the balance of this year, that we'll return to dividend paying at the half year. Lastly for me is, again, I think the business remained cash flow positive, caveating it with all of the programs that we took advantage of. But at the end of the day, it is a cash generative business model. We had about $800,000 of free cash flow in what was arguably as bad a year as anybody's going to go through. So, we certainly would envision that to double at a minimum as we look out into 2021. So again, testament to the business model, and we'll continue to try to grow this business as Jason talked about. I'll turn it back over to him.
Thanks, Brian. So yeah, I'll briefly mention ESG integration into our business. Our services at their core provide environmental benefits. In fact, for many years, we provide our customers with environmental impact reports you see there on the right. We've done that for 10, 12 years now. Later this year, we'll be publishing a full ESG overview and reporting platform that will certainly show our business in a favorable light in that. One thing I'll mention with going into the summary here, in the US, the price of cooking oil has doubled in the last year, and the price of waste oil has doubled. So what's happened is it's created a lot of demand for our service, hence adding nearly 1,000 sites during COVID. But in addition, the sale of waste oil on the back end has created a lot of cash for our franchisees. We take a margin on that. A lot of the cash goes to them, which is funding their growth. So we have a lot of machine sales in Q1 now, and everyone's looking to grow again. Put it in perspective, we help our franchisees in many ways, in sales and in recruitment. The franchisees are recruiting techs to grow. We help them. We've got 70 ads placed for them right now, trying to help them recruit technicians. So it's busy and it's growing again. So really the overarching message is our industry sector is recovering quickly now. We expect it to return fully by the end of this year so we can get back into full growth mode for 2022. Margins have improved and we now have the infrastructure in place to grow the business quickly. The next 2 or 3 years for us is all about sales, and the majority of our resources going into this. We'll continue to seek acquisitions. And for me, macro beats micro. You know, it's tough. Last year was tough, and fighting that has been hard for any business, particularly in our industry. But now we're pretty excited about the macro picture in the US and the UK with the market conditions coming over the next few years, and it's all about sales for us. So really, that's the end of the presentation. I'm more than happy to answer questions we have here.
Fantastic. Jason, Brian, look, thank you very much indeed for your presentation. And ladies and gentlemen, do please continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. But just while Jason and Brian take a few moments to review those investor questions submitted already, I'd like to remind you that a copy of the slides, a recording of the presentation, will be available on the Investor Meet Company platform via your dashboard. I'd also like to remind you that your feedback is important to the company, and immediately after the presentation has ended, you'll be redirected for the opportunity to provide your feedback in order the company can better understand your views and expectations. Jason, Brian, we have had some questions through there. I wonder if I could just ask you just to click on that Q&A tab and just have a little look down and see if there are anything that you can pick out and just add some more colour on. That'd be great.
Okay, let me answer. There's two that really come off the summary slide at the end there from Nick J. He says, you have a great gross profit. What room is there in your admin expenses to see more drop to the bottom line? I'm going to flip that and say, you know, our margins have improved, but we really have invested in the infrastructure now to grow the business quickly. We're not looking to reduce admin expenses. We're looking to not grow them any further, but we really are looking to grow that top line now and keep those gross margins the same. Ryan N says, are you looking to grow organically, or do you have more acquisitions you wish to do? We are looking to aggressively grow organically, and we have some, you know, some major plans into doing that at the moment. We're always looking for acquisitions when the right thing comes. I mean, the biggest acquisition we've ever done is WhatBio, which was right at the end of 18. It was hard, you know. During 19, getting that business right was difficult for us. Then COVID hit. I think right about last November, December, I said to the team, right, let's now get on the front foot. We've been defensive for now 2 years, one, you know, the WhatBio period and then COVID. Let's get back on that front foot. So we've been actively talking to people out there. There's nothing on the immediate horizon, but, you know, we've been talking to several companies over the last few months which haven't gone anywhere, but there is stuff. We're always looking. There'll be add-ons, there'll be bolt-ons to the business. So we're always looking for repeat revenues, and we'll always look for an opportunity to cross-sell products into existing customers of both companies. A question from Andy M. How sticky are your clients, and what's the sales process to attract new business? Can you also explain who you compete against and why you win? So let's take the US business first. So over the years, Filter Fry starting off was a very difficult business. It's an educational sell. So, you know, you got a block drain, you call a plumber. Nobody was sitting there saying, I really want someone to come and manage my fryers for me, please. Just didn't exist. So we had to go and create demand for it by explaining what it was. We overcame that hurdle really years back in the US. So it's known now that you can go do this. The sales process is, so we help our franchisees sell. It's normally a bottom-up approach. So we have these national accounts, so Exo, Compass, Aramark, Delaware, North, others. So even though you have a national account and we're the exclusive supplier to them, we still have to go and sell at a local level. Plus you have local clients. So we have an inside sales team. Most of our 14 people in the US are salespeople. So when a franchisee comes on board, he works, get businesses in the area. We give him work, stadiums, universities, the big stuff. And then they are supposed to go into the market and develop it locally themselves, but we can help with that. So a franchisee will team up with an inside salesperson at our place, and he'll say, look, I've got a wish list. Get me into the national accounts, great, but I've got a wish list. I've got these 15 sites, because they know their markets better than we do. They have these 15 sites they want us to get them in front of. So our sales team gets on the phones and tries to get the franchisee a local meeting with that customer. So the sales process really is driven from the franchisee and us going out to them. In terms of, we then do a very consultative sell. We go in and we monitor what they're doing right now. We then give a demo of the service, and then we start. From demo to service, about a 50% close rate. So it's good there. And normally normally we lose customers in two ways. You say there, how sticky are they? We'll lose them in the first month if the customer was overpromised at the front end. So we can save customers money. We could break even. People love a break even. If a franchisee is a weak salesperson, oversell, we can save you $1,000 a month, and they don't do that, the customer's not happy. So you could use it losing that first month, or when there's a management change. So 3 years down the line, new manager hits a site. We don't dictate where our costs go on their P&L. Might be in cleaning, for example. New manager, I'm going to get rid of that cleaning, get rid of filter fry. We have methods, and they don't see 3 years ago, they were buying 10 grand's worth a year more oil. They don't see that on this year's P&L. So we have records, a method of doing it that allows us to go back and say to the customer, by the way, can I have a meet with you? I know you think we're cleaning, but we're not. Look what you were doing 3 years ago. We've got photos of dirty fryers. We've got the amount of oil they were buying back then. That's all part of that upfront consultative sell that we actually gathered all that information. The real reason for that, one, you've got to see what service levels needed, but two, at a later date, you might well need it. So that over the years, these are the type of systems we've developed that help us keep customers. But sticky, other than that, we really don't lose customers in the US. In fact, when COVID hit, our sales team phoned 3,000 of the customers in a week to see, are they okay? Are you closing down? Do you need help with it? And to a man, the customer says, love your service. You're the first service we'll call when we get back up and running. So all the bigger customers still to come back. We don't think any of those will be lost. The stadiums are still there. They're going to be open. The universities are still there. So I think stickiness is key to the business over here. The average customer in the US is 8 to 9 grand a year for a franchisee. So, 20 customers on a van, fills it up. It's great. Then they get another van. It's just that regular repeat business every week. In the UK, the company-owned operations, going back to that last question, part of that last question was, what competition do we have? Primarily, it's in-house employees doing it themselves. People have tried to copy us over the years in the US. We sue them because normally anyone trying to copy us comes to a discovery day to buy a franchise. They sign a non-compete, and we've enforced every single one in the States. So we try to keep people out of the market. In the UK, our services, we have a competition out there in all of our services, apart from filter fry. We are the biggest. That's why we bought What Bio in the grease recovery unit operation there. So FOG. We are experts in that, and we now have by far the best equipment on the market, and we're seeing that being specified in many of the customers now. In other services, so seal, we have a patent on replacing a seal, but they replace seals themselves right now. We're just doing it in a different way. So we're the only people who can do it as a service, but seals are replaced. They can buy them online and replace it themselves. Pump, we're a very small player in the pump market. We do it for our customers that want it. We do a good job with those, and we're looking to expand that business, but there's a lot of competition in that. And the vent market, they're having their vents cleaned right now, manually. So, and it's by law, they have to have it done. So there's a lot of people out there doing that right now. We're looking to a better mousetrap to come and do it in there. So hopefully that answers your question about competition and how we sell. In the UK, customers are sticky. If you do a good job, which we do, we have, for example, with McDonald's, we have a 100% service rate with them. We're happy with them. They're happy with us. We have decent technology. They have portals they can log into us. We have APIs that log into their ordering systems. For example, at Mitchell & Butlers, they have a system where they place all their orders. Our API goes into their system. So they like the fact, the customers, that we're fully engaged with them, and that helps keep the customers sticky. I think that's answered all the questions. Hopefully that's given enough answers to those.
That's fantastic, Jason. Thank you very much indeed for addressing those questions. And if any further questions do come through, of course, the company will be able to review those post the event. Jason, perhaps if I could just ask you just for a final few closing words before we redirect investors to give you a bit of feedback, that'd be fantastic. Thank you.
Okay. I think I've said it during the thing. It was a tough year last year. We did pretty well through it. And if you'd have said a year ago, no one knew what was going to happen. If you'd have said a year ago, we are where we are today, I'd have snapped your hand off. So pretty happy where we are today. The macro picture now is improved for us, and all of our resources going into sales for the next few years. The next 2-3 years is all about increasing that top line for us.
That's fantastic. Jason, Brian, thank you very much indeed for updating investors today. Can I please ask investors not to close the session, as you'll be automatically redirected for the opportunity to provide your feedback. If you've accessed the meeting from our website, the feedback page will appear. But if you've accessed the meeting via the link sent to you in the email, you'll simply be asked just to log back in and submit your feedback. It takes just a couple of seconds, and we'd be really grateful if you would do so. On behalf of the management team of FILTA Group Holdings, we'd like to thank you very much for attending today's presentation. That concludes today's session. Thank you.